Let's talk about S Corporation versus C Corporation. So we want to look at the advantages and the disadvantages, the pros and cons, everything, okay? So here's an overview I want you to really pay attention to. So what are the pros and cons of S Corps versus C Corps? S Corporations are the most popular structure for businesses today. And the thing here is that, more than half of all U.S. businesses are S Corporations, and that share is even higher among small businesses. And the thing is that, when you look at the S Corporation, you got to really see why. Because an S Corporation elects to be taxed under Subchapter S of the Internal Revenue Code. An S Corporation is a federal tax status, not a legal business entity. So when you think about C Corporation, think about a state affair. But when you think about S Corporation, think about a federal affair. An S Corporation doesn't have to be a corporation. So LLCs, LPs, and traditional corporations may elect S Corporation status. So S Corps are pass-through entities, meaning profits from the business pass through to the owner's personal income to be reported on IRS Form 1040. And so it is one of those things where you have to really understand what's really happening here. And so the S Corporation is a constant. So if you analyze the U.S. economy, especially when it comes to small businesses, you have a larger slice of S Corporations that comprise the U.S. small business community. Okay. It's really important to understand that S Corporations is pretty flexible, but this flexibility comes with a lot of strict sort of paperwork, like when it comes to a paperwork coordination, when it comes to just a record keeping, the IRS is pretty strict about that. So that's for an S Corporation. What about a C Corporation? Now, a C Corporation or traditional corporation is a legal entity authorized by the state to transact business, and it is actually a separate body from its owners with its own assets, liabilities, obligations, and rights. So if you incorporate, your business is automatically a C Corp. And C Corporations pay corporate income taxes on profits using the IRS 1120 tax form, and any profits that are distributed to owners are taxed again as personal income. So that's the whole idea of double taxation that really is inherent to C Corporation taxation, okay? Double taxation, but for S Corporation, you have a pass-through taxation. By the way, boss, welcome back to the show. It's really a pleasure to have you here. Make yourself comfortable. You are going to enjoy today's conversation. Now let's talk about S Corporation versus C Corporations. What's really the difference here? Now, the fundamental difference between S Corps and C Corps is that an S Corporation is a pass-through tax structure, and a C Corporation is a legal business entity taxed as a corporation. Now, let's look closely at the main differences between S Corps and C Corps to see how they might affect your business taxes and operations. Now, I first want to talk about ownership options. So, S Corporations were designed for smaller businesses. To qualify, your business must be owned by U.S. citizens or residents, or let's say legal residents, must have no more than 100 shareholders, and must have only one class of stock. And so this is kind of cool. And these rules can trip up businesses that do not fully understand the implications for ownership and profit distribution. And C Corporations can have foreign owners, unlimited shareholders, and multiple classes of stock. So the winner here, C Corps, because S Corporations are suited for smaller domestic businesses that want to treat all owners the same way. C Corps gives companies unlimited growth potential and flexible options for ownership and profit distribution. So what about limited liability protection? So one major incentive to incorporate your business is to actually shield yourself from personal liability from the company's debts and legal obligations. So S Corporations and C Corporations both provide limited liability. So here there's no winner, so we have a tie. And so the question is, let's talk about pass-through versus corporate taxation. So income from C Corps is taxed at the corporate level. When profits are distributed to owners, they are taxed again as personal income. So S Corps benefit from pass-through taxation, which really eliminates the double taxation on corporate income and simplifies accounting and tax returns. So the winner here, this is a close tie, because since the C Corp tax rate is 21% under the 27 TCJA, the Tax Cuts and Jobs Act, the corporate tax bite isn't as deep as it used to be. But S Corp are still often better for small businesses. So depending on your profit levels and personal income tax brackets, this can go either way. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about S Corp versus C Corp. Let's talk about qualified business income deduction. So, as passed through tax structures, S corporations receive the added benefit of the 20% qualified business income QBI deduction, which can substantially lower your S Corp tax rate. So the winner here, hands down, is S Corp. What about handling of losses? Let's talk about that. So owners of S corporations declare losses and use them to offset other income. C corporations cannot pass losses through to their owners. So the winner here, again, is S corporation. And so this is really important to really remember. What about profit distributions? Now, before you actually analyze the profit distribution, you got to really understand how C Corps and S Corps are different when it comes to a profit allocation. Because S corporations can have only one class of stock, they must distribute profits proportional to shares of ownership. So if two partners own 60% and 40%, profits must be split 60-40. Corporations have a ton of flexibility in distributing profits. And so profits can be kept in the company or distributed as dividends. And so issuing different classes of stock also makes it easier for C corporations to attract investors and shareholders who don't participate in the business. So the winner here is C Corp, hands down. So when I talk about the profits can be kept in the company or distributed as dividends, that's what you have the concept of retained earnings. Okay. But remember though, when we talk about C corporations, we're speaking about a state affairs. In other words, the C corporation is a C corporation incorporates, if you will, at the state level. But then the S corporation is a federal construct. In other words, there is no legal structure called S corporation. You actually are either an LLC, a partnership, or a C corporation that elects to be taxed as an S corporation. So this is where the difference is. So when we talk about profit distribution here again, the winner is C Corp because of the flexibility. Okay, the flexibility and also the fact that you are able to attract a large range of investors from all over the world. Remember, when we speak about S corporation, you got to have folks who are already here in the States. So it has to be either a corporate, it has to be American citizens or legal residents. And I want to talk to you about fringe benefits. So in C corporations, fringe benefits are generally deductible at the corporate level and excluded from employee income. Examples include life insurance, healthcare insurance, travel expenses, and adoption assistance. Okay. And in an S corporation, the cost of these benefits may pass through to employees as compensation and be taxed as personal income. So the winner here, in our view, is C corporation. What about complexity and paperwork? Well, incorporating your business dramatically increases the administrative, legal, and financial paperwork you need to tackle every single year. And so a robust document management system is kind of critical to stay on top of all that documentation when you really think about it. And so the winner here is S corporation, but it really depends. Since S corps are pass-through entities, their tax returns are usually simpler than a C corporations, but their more stringent ownership and profit distribution requirements can actually up the legal and financial complexity. So this is what it is. One thing I want to say here is that when we talk about, so this is actually, I've actually gone through a compare and contrast of all the different criteria that you need to pay attention to in terms of when you analyze, in terms of analyzing S corporation versus C corporation. Okay. Now, if you want to elect S corporation status, you got to file something called 2553. So this is the IRS form 2553. So you can see on the screen here, this is how form 2553 looks like. And so it's called, the official name of the form is election by a small business corporation. And this is where you basically can, you can elect to be taxed as an S corporation. So just to kind of quickly remind you, you can be a single member LLC. You can be a multi-member LLC. You can be a partnership. You can be a C corporation. You can be all of that and elect to be taxed as an S corporation. But for that election to actually be active, you need to file this form that I'm showing you right now on the screen, Form 2553. and that's the form that actually tells the IRS that going forward, I want to be taxed as an S corporation and no longer as my default, let's say 1065 or 1040. Boss, I want to quickly remind you of today's topic. We are having a conversation about S Corp versus C Corp. Determine whether an S Corp or C Corp is right for you. And so based on all the factors that I just listed for you, things like ownership, options, limited liability protections, pass-through versus corporate taxation, qualified business income deduction, handling of losses, profit distribution, fringe benefits, complexity, and paperwork. Based on all these factors, the scorecard could actually tip either way for your small business. So a seasoned tax professional can determine which would provide the greater tax advantage for your business, your specific business. And a corporate attorney can advise you on the complexities of ownership and profit distribution. It's really important. And so now let's really sort of look at the pros and cons of all situations that really can affect your specific sort of case here. So when does an S Corp make sense? So S Corps are best suited, in our view, when business owners want to draw profits as income. If most profits will be distributed, you can bypass double taxation with an S Corp. This is really important. And so an S Corp really makes sense also when business owners can benefit from losses. So if you can actually use the losses from your business to offset other income, an S Corp might be right for you. And the situation is also great if you as a business owner, you have a low personal income tax rate, because a low personal income tax rate combined with the potential QBI deduction and self-employment tax savings may mean major tax savings with an S corporation. And it's also great when business owners actively participate. So if all owners are working in the company in proportion to their ownership, an S corp might be good for your business in our analysis. Okay, so it's one of those things where you have to see what really adapt to your situation. So that's when an S corporation makes sense. Let's also talk about when a C corporation makes sense. C corporations are better for businesses that have foreign connections. Unlike S corp, C corps have no limits on foreign ownership. Businesses that reinvest profits. So C corps let you build wealth in your business without drawing it down as personal income. And businesses that need unlimited growth potential, C corps can issue unlimited shares of stock. C corps also C corps are better for businesses that have different types of shareholders. So a C corps lets you issue different classes of stock to accommodate a mix of active participants and investors. So this is kind of cool in terms of looking at the mix of investors that you have. And it's also great for businesses that have owners with high personal tax rates. So if your personal income tax rate is higher than C Corp tax rates, currently set at 21%, you may do better with the C Corp. And if you want to attract investors, traditional corporations are more attractive to investors. Let's talk about the steps you need to really pay attention to if you're thinking about S Corp versus C Corps. How do you actually form an S Corp or C Corp? By the way, I have to tell you that LLCs and LPs must file Form 8832 to be taxed as a corporation before making the S Corporation election. Okay, and so let's go back to how do you form an S Corp or C Corp? So to form a traditional corporation, you got to really file articles of incorporation with your state corporations bureau, usually the Secretary of State. And what happens here is that your corporation will automatically be a C corporation. And so to be taxed as an S corporation, you must then file IRS Form 2553. And so I think I showed you that form earlier. And so if you have a business entity such as an LLC or a limited liability partnership, as I just said, you must first file IRS Form 8832 and to be taxed as a corporation. And all shareholders in your business must sign both forms to show their consent. And if you happen to be an unincorporated business such as a general partnership, a qualified joint venture, or a sole proprietor working under a doing business as name, you must form a legal business entity to become an S corporation. Okay, and this is kind of important. And so, bottom line here is that you need to understand that you have a few steps to really follow before you can be recognized as a corporation, before becoming a an S corporation, by the way. So to form a C corporation is more straightforward. Things happen at the state level, and you get your C corporation sort of charter, and you are seen from the get-go as a C corporation. But for S corporation, things are a little more convoluted. Let me give you the verdict here. So when we talk about the S corporation versus C corporation, we need you to really understand that the winner really depends on your status. Okay, we have two champions because S corporations and C corporations provide very different and potentially powerful tax benefits and ownership capabilities. So finding the best fit for your business takes financial and legal savvy. And so what you want to do here is that you want to investigate all the benefits on both sides and get professional advice on your options. And so with some due diligence, you can make sure your business is actually positioned to reward your efforts and fulfill its potential. And one thing I want to say here is that at the end of the day, you got to really understand that C Corps are totally different from S Corps. And it's one of those things where when we think about C Corp advantages, limited liability for all employees, shareholders, directors, and officers. No restrictions on number of allowed shareholders. No restriction on shareholders' countries of origin or corporate statuses. It's easier to raise equity financing than S Corps or other forms of business structures. As a C Corp can issue more than one class of stock. You have a lower maximum tax rate compared to the maximum personal tax rate that would apply to S Corps, sole proprietorships, and partnerships. So this is kind of good. So this is really great. And what about the S Corp? What about the C Corp disadvantages? You have double taxation. You have no personal write-offs. And corporations have a more rigid structure and are more expensive and time-consuming to maintain than other business structures. Okay. And so that's for C Corps. What about S Corp's pros and cons? Well, S Corp's pros, you have limited liability for directors, officers, shareholders, and employees. You have pass-through taxation, avoiding the double taxation of C Corps. You have corporate losses can be passed through to owners in some cases. And you have independent life from shareholders, meaning the business can still continue on. It can continue on if key shareholders depart, just like a C Corp. What about the S Corp disadvantages? Well, maximum limit of 100 shareholders. There's a strict shareholder requirements that stipulate that only U.S. citizens, permanent residents, and certain domestic trust, estates, and tax-exempt organizations can hold stock. Partnerships and corporations are ineligible to hold stock of S Corps, and you can only have one class of stock. And it's harder to raise equity financing than C Corp. So if you have an S Corp, and you have more scrutiny from the IRS, especially with regard to the balance of salary payments versus dividends. And so this is what it is. And corporations in general have a more rigid structure and are more expensive and time-consuming to maintain than other business structures, whether we're speaking about S Corp or C Corp, by the way. Thank you so much for your attention. I really appreciate it. In today's conversation, I was just talking to you about S Corp versus C Corp, and we did a quick recap here. So I gave you the overview, the steps, the verdicts, and now the recap. Thank you so much. God bless you. I'll speak to you another time. Until then, remember, stay marvelous.